Okay, class, how are we doing? This is Professor Carey. Due to the snow again, it's the third time you guys have had the day off, so we're not losing too much time. I'm going to build a video for you guys and go over what I went over with the other class. So it'll be a brief PowerPoint presentation slideshow of Chapter 3, the remaining part that we didn't finish last class. So please watch it, and we'll run through a couple of highlights during class, but in order to keep moving ahead so we don't lose too much time, I want you guys to do this on your own today. Okay, so last class we stopped here, okay? We were at the summary of the cash flow. So just to highlight that, remember when you look at the balance sheet, okay, and if you can follow along, if you look at the balance sheet, cash started at 84, it ended at 98, so there was a change of 14. So that's on the balance sheet ending at a certain year. And it has to end the same year of the income statement that you're looking at, that you're using to reconcile. So bottom line is you reconcile the balance sheet using cash. In this case, it increased, went from 84 to 98. Okay, and so when you run through all the cash flow, when you run through all the cash flow statements, operating, financing, and investing, and run through each of the numbers, you get some total numbers. Add those up, and those need to match exactly to the cash. So in class, we went through operating, that came to a positive 619. Investing came to a negative 425. Financing came to a negative 180. All that together matched up to 14, and that's all good. Okay. So what we're doing here is looking at standardized statements. So in accounting, the accountants build statements, of course, but sometimes we don't really know how well we're doing relative to our competition or other companies within our industry. So this part, the standardized statements, has two components: common size and common base year. Common size, when you are looking at the balance sheet, you want to use the total percentage of assets, which is 100%. When we're looking at the income statement, you look at sales as a percentage of 100. So everything else will be a percentage relative to that item, depending on what statement we're looking at. So and then the common base year, that is if you want to look at one company, their income statement or their balance sheet, and how it's moving from one year to the next. So you would look at each line item. Has it gone up 10% or 20%, or has it gone down? And the whole idea is, you might see one company that you think they're doing really well, okay, but on a percentage, maybe not so, or they're lagging behind their competition. For example, Walmart. Walmart has a very low profit margin, low numbers, but they're the most profitable company, or at least one of the most. Apple Computer, on the other hand, the profit margin is about 20-21%, but they're not necessarily making as much money. So the point being that it's not just what you're making more money by a higher profit margin. Okay, obviously Walmart makes it up in their volume, but this is what these statements do. They allow you to look at some statements and make some relative comparisons, regardless of the numbers, whether you're up or a small company or a large company. Relative to this company, I'm the same. I'm just a lot smaller. My numbers are smaller, but the percentages might be identical. So let's look at this, common size. This, of course, is looking at the balance sheet. So if we look here, remember, if we're using the balance sheet, we look at total assets, we make that 100%. So this 2.6 million is 100%. All the other items are going to be some percentage of the total assets. Okay, and this, of course, is the left side of the balance sheet. We can do that with the right side, with the liabilities. So in this case, we have cash as 1% of the total assets. Your accounts receivables are about 19%. Inventories are about 38%, and so forth. One thing you want to be aware of, where I have these little dashes, you wouldn't want to necessarily make a percentage there because, as you see, this is a total asset line. So that's simply adding all these together. So, you could add these three together and use that number if you wanted, okay? But you don't want to use 1.5 as a percentage of 100. It's not going to show the picture we really want, because you'll get a percentage here, and then all that will not add up to 100. It'll be greater than 100. Okay, so this would be 38% plus 19 plus 1%. But adding that into all the percentages would get you over 100%. So, likewise with the gross fixed assets, okay, and less depreciation, okay, you want to use net fixed assets, the final number, okay, because these two roll into that. If you did it, you just would have to make a note that it's not an additional percentage. So that's basically the common size. And again, to recap, that helps us look at a small company and a large company. And percentage-wise, you might be doing very similar to that company. Obviously, you're a smaller company and your sales are not as great. Your profit margin is not as great, but on a relative scale, you're doing the same. Okay, the next one, common base year. Again, what that is looking at is you're looking from one year to the next, and you want to notate the changes. So this is a lot like when we talked about income statements, that you look at income statements from one quarter to the next. That's the idea with this. It puts all the data, listing it for 2014, and then we want to see, has our cash gone up or gone down? Have our receivables gone up or down? By what percentage? Have the inventories gone up or down? What percentage? And then it helps us gauge when we look at another year, we have an idea what we want to shoot for. And we can see, okay, this line item is going down, it's going up, it's staying flat. Is that what we're hoping it for it to do? Okay, so that's common base. That's the other type of analysis you can do on these statements. Ratios. Okay, ratios. This is again where we start to pull away from the accounting field. Okay, it's where we start to commission the finance person. We want to look at all these numbers, income statements, balance sheet, and make some sense of it. Tell us what's behind the curtain, what's happening with all these numbers. What does it really mean? They look great, statement looks great. However, it could be a fallacy. It could be clouded with some incorrect data, or once we look at some financial ratios, it might tell the true picture. So generally, these ratios are going to be used over time and against competitors, and it helps us analyze the industry. It helps us sort of set a benchmark for where we want to move away from or to, and it helps us look at a trend. because if you look at the income statement, the balance sheet, it's a lot of stuff going on. But if you take two of the numbers and isolate that, then it takes those two numbers, gives you a percentage, or a multiplier as they call it, and that is easier to digest and make sense of. Sometimes looking at all the numbers, you're not sure how well you're doing. And by the way, you can create your own ratios. The ones we're going to go over, the more conventional standard, but there's really no limit. If there's something you would like to analyze that you think is important, you can grab two of the numbers and see how they move with one another. Okay, for the sports people, think of a basketball game or a football game. All you see are the stats and numbers. If you start comparing that shooter's numbers with some competitor or with the other guys on the team, or with the other team, how many baskets were made, it will tell a different story. Okay, so that's in essence what we're looking at here, except with a company. There are 5 basic ratios that we're going to dig into, 5 categories: liquidity, debt management, asset management, profitability, and market value. Okay. Real quickly, in summary, liquidity ratios look at how easily you can move current assets into cash, and how quickly and how easily are we able to pay off our current debts. Debt management looks at that age-old question: is how much debt should I have and how much equity? If I want to raise 10 million bucks, do I sell stock or do I sell bonds? And what combination is appropriate? Debt is something we have to pay back, but there is no ownership. Equity, we get money from investors, but now they own part of the company, but we don't have to pay them technically. Bond holders have to be paid first before stockholders. Asset management. The simplest way to think about this is how well are you utilizing your assets in comparison to sales. So the example I like to use for college students is at New Paltz, for example, there are about 700 students. With that, we have buildings, computers, trucks, equipment, etc., to run a school. And New Paltz is probably near capacity. If they had 2,000 more students, we'd have to build more buildings, etc. If we only had 2,000 students and we have all this equipment, we're not utilizing our assets that well. We're under capacity. So those ratios will help us figure out how well are we utilizing all the assets we have within our company. We might be at 50% capacity, and we have to say, okay, what should we do about this? Either sell some of the assets or get some further use out of them. Profitability. There are a lot of numbers and ratios that we use internally that managers want to see. What is my profit margin? What is my return on equity? What is our return on assets? Okay, kind of tying into this part. Asset turnover, sales turnover, a whole host of things we'll look at. But generally, that's looking from the inside of the company. Now, conversely, the market value, these are ratios that investors will be highly interested in your company before they buy stock or before they invest. They want to know, what is the price-earnings ratio? What is the market price of the stock versus its book value? Okay? Those kinds of things will be of great interest to the outside investor. Okay, the liquidity ratios, current and quick. If you look at this, we've studied this in a different way. If you remember, net working capital is CA minus CL. current assets minus current liabilities. That is that's a dollar amount, so your working capital, what you have left after you've paid your bills, in essence. This is a ratio, though. It's simply those same numbers, but turned into a ratio that, again, may be easier to digest, analyze, study, and make comparisons to subsequent quarters or years. And sort of an interesting thing, if you might think on the surface, well, wow, if this C over CL, if it's 100 over 50, so 100 assets over 50 liabilities, that's good. Maybe if I get 4 over 1, 5 over 1, 6 over 1, if that number keeps getting higher, you might think that's much better. It's good, but the problem you want to understand is within those current assets, if you're building too much cash, it's sitting idle, you need to do something with it. You need to invest it. If your accounts receivable, if those are getting large, you've sold a lot of things, you've sold products, sold computers, whatever your business is, but you're having trouble collecting. So that receivables may be getting too high. Inventory, that means you have too much inventory sitting in your warehouse collecting dust, so it needs to get sold. Quick ratio is simply a derivative of that. So because inventory is the least liquid, they devise a ratio that pulls inventory out of that equation. So that's a better measure of how well you are managing your day-to-day activities. So it's simply the current assets, that total number, pulling out inventory, and how that stacks up against current liabilities. Okay, moving ahead. Debt management. This debt management, total debt ratio, one thing we need to remember, in the basic equation, assets equals liabilities plus owner's equity. Within liabilities, there are two things: debt and liabilities. Debt typically are the long-term bonds. The liabilities are the accounts payable, those things that don't have interest linked to it. So in this formula, if you notice, it's not including the interest-bearing debt. And that's simply those accounts payable. If I borrow, if I buy some lumber from you and you send me a bill, I haven't paid you yet, there's no interest that's going to be linked to that bill. So this is simply looking at total assets, backing out the equity over total assets. So it's not including the interest-bearing debt, okay, debt to equity. Because if I have total assets minus this top one, total assets minus total equity, what does that imply? That if you have that, what's left is the debt, okay? Total assets minus total equity, look at that formula. That actually, another way to write that would be total debt. Okay, so this is that equation. Liabilities includes debt, payables, notes payables, plus owner's equity. Okay, debt would be this, and notes payable, not accounts payable. Okay. Debt management. This one is absolutely an important one. Tie ratio, times interest earned. And we're getting back to that EBIT. Okay, we're going to keep, kind of hounding you guys on that EBIT. EBIT is earnings before interest and tax. That's your operating income. That is your operating income, to repeat. It does not include interest. It does not include taxes. Okay, so that's operating income. So imagine this number is not that high, but I've sold a lot of bonds. I've borrowed money. I've sold you guys bonds. At some point, I have to pay you back that original principal plus interest all along the way. If I'm not doing well in my business and I can't afford to pay you interest, that company is going to probably go under, bankrupt. So if you look at this EBIT here, EBIT over interest, that has to be, 3 to 1, 4 to 1, 5 to 1, a healthy ratio. If your EBIT to interest is 1.5 or even 2 to 1, that's getting pretty close, meaning if you have a bad year, something happens, you're not going to have the money to pay the interest that you owe to your creditors. Now the book, that's what I've always used in the finance class. This book actually takes it a little step further. They call this the cash coverage. That's the same thing except it's adding back that old interest, okay? Because, depreciation, excuse me. EBIT plus depreciation, because once again, as I've harped on all semester, last couple of weeks, that's a non-cash expense item. So you in essence, you can add that back. We will generally work with this for the most part, but that's important to know that you can add back the depreciation. So, are you making enough to pay your interest? Asset management and turnover. So this ties in pretty closely with what we've talked about. Think of this inventory turnover. Just think of a real simple example. Think of a warehouse that has 100 items in it. When you finish selling what you're selling, you have 25 left. Okay? So the implication is within a year, you're selling it 4 times. So 25 into 100. Okay? If you have 25 left, your cost of goods sold was 100. So you sold 100 within the year, and that's reflected on the income statement. You look in the warehouse, there are 25 left, 25 into 100. The implication, the thought process is that happened 4 times that year. So you turned over, you sold a lot of 20. Excuse me, had to get a little water. Sorry, guys. So if you look at inventory turnover and you sold 100, cost of goods sold, your inventory is 25. 25 into 100 is 4. They're 4 times. It happens 4 times. It's much better if that number's higher. The bottom number is higher. So the example to the right of that, okay, 100 over 10, that means you only have 10 units sitting in inventory. So you've sold it a lot faster. You're turning over. Your cost of goods is moving much quicker. Turnover is 10. So I'm selling 10, 10, 10, 10, etc. through the year. Here, you're selling bunches of 25, 25, 25, etc. So ideally, you want that number to be higher. Okay. Days sales in inventory. Okay, that is looking at basically going from sales. Day sales in inventory. Actually, I'm sorry. This number, okay. Another way to represent that. This one, 10 over 25. Okay, it happens 4 times. Another way to interpret that is 4 into a full year is 91 days. So each of those bundles of 25 that you're selling, it takes 91 days. So imagine 91 days to sell a block of 25 something, another 91 days to sell another block of 25, and so on. So your inventory days sales in inventory is 91 days. Okay, asset management and turnover continued. So now we want to look at receivables turnover, sales to accounts receivable. So the time frame from going from sales, from sale to accounts receivable, how quickly is that turning over? How many times is AR turning over? So we've sold something, it goes on the books, and when do we get paid? Okay, sold something, hits the accounts receivable, okay, turns into cash. How long is that taking? How many times is that happening? So again, I'm using sort of an extreme example to explain this. If your sales are $100 and you only have $1 sitting on accounts receivable, that's great. That means you sell something, they pay you. You sell something, they pay you. That would almost represent a retail, meaning cash sales. So there's not that lag time between sending an invoice out, billing your clients or customers, and waiting for them to pay you. So that's a high turnover. That's great. You know, it's not sitting in accounts receivable. If you look on your receivables, that number might be low, and that's good. You know, you're getting cash. Another example, more realistic, if your sales are 100 and you have $12 sitting on accounts receivable, okay, that's 8.3 times. That's happening. It's turning over just over 8 times. Okay. Now, how do we interpret this? There's something called days sales in receivables. Another term you may hear in different books, DSO, days sales outstanding. Okay, days sales outstanding. That's one method. That's another way. That's basically two different names: days sales and receivables, or DSO. So let's look at what's happening. If we use the way the book has it, they say 365 days, a full year, over the receivables turnover that we got from this page. Okay, so 365 over 8.33, that's approximately 43 days to collect your money from sales. The day I sell it to the day that I collect is about 43 days. If you use this formula, DSO equals accounts receivable over sales over 365. If you do the numbers, it works out the same way. So DSO is 43 days. That equals your accounts receivable is $12 over total sales revenue, 100, over 365 days. Okay, both methods work. Okay, again, you may see those in different books. This one, pretty easy. Net working capital, we've studied that. This one is sales over net working capital. Okay, that's about all I'll say for that. It's not real common. Next one, this is sales over fixed assets. This is an important one that I've used a lot. You can look at just fixed assets or your total assets, meaning fixed and current. Again, getting back to the students at Paltz, if you have 7,000 students, okay, and we have X number of assets, that's probably at capacity. If you think we have the same assets, but now sales would be students, if they dropped to 2,000 or 3,000, the turnover would be off. You know, something would be off about that. Excuse me, a little tickle in my throat. This one, profitability ratio. Again, this looks internally. Internal managers will look at this. Profit margin is a big one. Bottom number net income over sales. Real simple, but that's one that people want to know about. If you guys get a business, your friends and family will say, hey, what is your profit margin? That's a simple way to find out. Okay, and that will tell you a lot about what's going on in your company. One thing you need to understand is some businesses, hence i.e. the Walmart, they have a low profit margin. They do very well. Unlike Apple, has a high profit margin, does very well itself, but they both have very different profit margins. And it's indicative of the industry they're in. The food, Hannaford, grocery stores, etc. It's a pretty low margin, but there's a high turnover. Walmart is a high turnover. They're bringing goods in, toys and food and all kinds of things, and they're moving that pretty quickly at low volume, low cost. High volume, low cost. ROA, return on assets, NI over total assets. Net income over total assets. Return on equity, net income over total equity. Okay. Sometimes I put a footnote here. Some books will show it, just the nature of those, ratios. They may show it from average 1 year to the next, because if it's a windfall or something happens drastically, they may want to get an average to get a better flavor of what's happening in that company. Okay, because that one number might be a little bit skewed if they have a big year, so they might average the two together. Market value, okay, for investors, that's what we look at as an investor. Earnings per share, we touched on some of these. Net income over the number of shares. Okay, that's how many shares are outstanding out in the public. This again is common stock. Okay, so it actually backs out if number of shares, you had 10,000 and you had 1,000 of preferred stock, you would back out that 1,000 and you would show 9,000 shares. PE is a price per share over earnings. Okay, it's basically telling the investor, okay, I'm willing to pay X number of dollars for these earnings. That's my threshold. Market to book. Remember, in the accounting world, things are listed at the book value on the balance sheet. Okay, day one, all that's recorded. 10 years later, that same number stays on the books. The actual value of that item, of course, will change, and investors want to see if it started at 10, the market value is now 30, it's gone up from 10 to 30, that's important to them. Or I guess it could have gone down. But market to book ratio is a big ticket item for investors. In particular, they will look at the market value of a stock. So if IBM, I don't know offhand what it's selling for, but if the book value is 50, what do you be 50? That's way too high. 10, and the market value is 100, that's their interest, going from 10 to 100. It's grown that much over the years. The DuPont equation, I listed this. This is the full-blown. It's return on equity equals ROA, return on asset, times an equity multiplier. If you want to break that down further, this ROA is made up of PM times TAT. Okay. If you want to break that down even further, ROA is net income over sales. Okay. Total asset turnover is sales over assets. This is assets over total asset. Now, if you notice something here, if you lay this out, you could actually cross out the assets. The sales would be eliminated, and the assets. If you lay them out kind of mathematically in the equation, you would see that those would cancel out, leaving you net income over total equity. But there are going to be some times and problems that we give you that you'll need this full breakout, or you'll need to use this part of the equation, okay, depending on what is given. But the whole point of this, it helps us identify what is causing the return on equity. What component within this big, massive equation, this big company, is it sales, assets, net income? What actually is affecting that end result? So that's the point of that equation. It was actually devised by some folks in DuPont Chemical Company for internal reasons. Equity multiplier. I made a couple slides because this is always gives students a little bit of trouble, and I think you'll see why. But let's break it down real simply. If we remember, assets equal liabilities plus owner equity. Okay. In this case, in many of the cases we're going to look at, the liability is assuming just debt. Okay. No accounts payable. So if you just plug some numbers in, 100 equals 40 plus 60. Okay. 40 being the debt. Okay. 60 representing the equity. Your debt to equity is 40 over 60, or 0.66. Okay. So if we look at debt to equity, 40 to 60, okay, the equity multiplier in that DuPont equation reads equity multiplier is total assets over total equity. Okay, total assets over total equity. So that's a different number, but it's all part of this debt to equity, and you'll see why in a second. So you'll see that listed this way. So EM is total asset over total equity. So let's use the numbers that we have. Total assets should be 1, right? Okay. If 100%. So if this is 40%, 60% of some number, that's 1. 1% equals 0.4 plus 0.6. Okay, so it's always going to be a percentage. So 100% or 1, total assets, over the total equity. We have that from here, 60%. So 1 over 0.60 is 1.667. That's your equity multiplier. Now let's see how we can get that same number from the debt to equity, from the, here we are, from the total debt to total equity relationship. Okay, so just to recap, we have this number we just came up with. And it's a multiplier, equity multiplier. It's a 1.667, okay? And a multiplier is something that's greater than, 1%, 100%. So if we look at total assets to total equity, total assets again is represented by 1 or 100%. Total equity was 0.60. That gives us 1.667, okay? Now, written another way, which we will see this, so you sort of understand how it's derived. Equity multiplier equals 1 plus total debt over total equity, okay? 1 plus total debt from the earlier slide was 0.40. Total debt is 0.60, okay? So 1 plus, that's 0.667. Add back the 1 is 1.667. So either way, you get back to that. Excuse me. Either way, you get back to that equity multiplier. Okay. Again, you'll see it this way: 1 plus debt to equity ratio. Okay. So the ROE is affected by operating, asset, and financial leverage. Everything. You know, the operation is a PM. Assets are the total asset. Financial leverage is the equity and the debt. Okay, so that's what that DuPont equation is trying to really piece together. It's trying to peel back all the layers and see what is making up the return on equity. Okay, so it kind of decomposes that equation. All right, so I'm going to stop there and we'll finish up in class, but at least I want you to take a look at that, follow along with me, and see if you can, absorb that. I will see you guys on Friday.